Yeah, I'm losing my edge.
Let's jump into it. Let's talk pairs trading stocks today. Over the last, I guess this is one of those things, Michael, that you always want to think is like a novel idea. You know, stocks and stock sectors moving in different directions, but it's probably happened since the creation of public companies that you could follow the price and market capitalization of. But I do want to point to the last decade of movement between technology and everything that is not a technology company has been really crazy and has created a lot of news items, but also just real trading opportunity when you talk about this stock versus that stock. And right now, today, we're seeing a little bit of reversal of that trend. You've got technology stocks down about 2 or 3% this afternoon, and you've got major indices that have technology in them but are more diversified, like our small stock 75 or like the Dow Jones or S&P 500, that are around unchanged or even positive on the day. So that is just a small reminder for how much interesting opportunity there lies between stock A and stock B. Not just are stock A and stock B going to go higher, but how are they going to perform against each other? That's a unique opportunity that we're going to dig into here.
Mm-hmm. Yeah, I think that's a great point, and it's kind of a fun and new way to look at markets as well. Pete and I discussed this last week a little bit in the currency sphere as well, where this is a pretty popular strategy, pairs trading.
Yeah.
But we're looking at euro and we're looking at sterling, both kind of middling in their performance. Hard to set an expectation and form an opinion on where you think either will move. But then you stack them against each other, and you have this interesting extreme. And that was where we happened to see opportunity last week. And I'm excited to see the lens that you're looking at stock markets today and how you could trade them against each other.
Absolutely. I think the uniqueness is definitely the really cool part of why you would look at pairs trading. We often talk about risk reduction and stuff like that, but I don't even want to get into that. Those are benefits that I'm not even touching on here this afternoon, Michael. And we can get into that later. I want to talk about just the intriguing opportunity here. Why are there so many different equity products, Michael, that offer a similar trade? Why would the small exchange, other than wanting to create small products that are standard, easy for the average trader or investor to handle, besides all that crap, why would we put together stock products? The Dow Jones has been around for 100 years. S&P has been around for 50, 60, 70 years. NASDAQ's been around for a good chunk of that as well. Why would we create a stock market that has a high correlation here? Shouldn't there just be one stock market?
One stock market to rule them all, no competition. Stick with everything from 100 years ago.
You either buy it, or you either buy one thing or you sell that one thing, and then that's the end of it, right? That's the one trade.
Well, it's fun to it's fun to poke fun of some of the stuff that's been out there for so gosh darn long, and just quoting the amount of time these traditional products have been in existence is almost one case for why you need something a little new, something a little more refreshed. You're not driving a Ford Model T in 2020. You're taking the revamped version, or you're driving a Tesla or some newer technology with these new products. We're offering kind of a novel take on equities. And I think Small Stock 75 highlights this, as does STIX. But when you choose the constituents that go into Small Stock 75, we choose those stocks based on a number of factors that other indexes don't consider.
Yeah.
We look at things like volatility, which is a weighting factor in choosing the stocks in Small Stock 75. So you have a product that probably moves a little bit more. Mathematically, it does move about 30% more than the S&P 500. And STIX has its own unique properties as well, in that we don't just look at, the major 5 tech stocks. I think FANG is a pretty popular acronym out there, but there's so much more than just FANG. There's biotechnology stocks that don't represent themselves in a FANG index product. And it's an important part of the technology sector. I mean, you look at COVID, the pandemic of the last year, biotech stocks are certainly interesting and relevant in what's happening in the news today.
And I'm glad that you dissected it like that, because, if the answer to this question was there's no reason for there to be different equity markets and there should just be one that everybody wakes up and either buys or sells, then this segment would be over 13 minutes too early and producer John would be angry. But the reason why is because not all stock products act the same. Whether you're talking about individual stocks, the most people, when they get onboarded to pairs trading, the most basic example is Coca-Cola versus Pepsi.
Yep.
Right. You've got two companies that essentially do from a broad level. And I know people who maybe work at these two companies might get mad at me. They essentially do the same exact thing. OK, and so you would look at pairs trading those two things is like, OK, their correlation is high. They have essentially the same business. They produce the same product. They have, similar marketing campaigns. On down. Pairs trading those two is a very interesting endeavor relative to, are soda providers going to go up or down in the next year? Betting on Coca-Cola versus Pepsi is a very intriguing matchup there within the stock market. And it brings us to this STIX versus SM75. You've got this 0.8 correlation. You've got a lot of crossover here, both of these indices containing Apple, Amazon, Google, Microsoft, Uber, and Wayfair. But you still have, Michael, right now, a 25 to 30% divergence, actually at right now, 30% divergence between these two entities on the year alone. A 30% performance in an individual stock or stock index is a lot for two indices that are positively correlated and have a lot of crossover. To perform differently is very intriguing, right? It's almost like, I love to go to sports analogies all the time, but like betting on this sports team is one thing. It's like, oh, I think the Bears are going to win the Super Bowl, and so I've got my Bears bet. I think stocks are going to go higher. I've got my stocks bet. But you can also then play fantasy football or play, pairs trading stocks and say, okay, I've got that Bears bet, but I also think that Baltimore's quarterback is going to perform better than Kansas City's quarterback. And you've got these moving pieces within what was a simple singular structure here. This is a lot of opportunity. 30% is huge. And right now, today, just for a little context, we're seeing a 3% move between these indices just on the day. That's a ton of movement, a ton of opportunity that doesn't require that I say Coke and Pepsi are going up or down. It just is, which one do I think is going to outperform?
And that great point with the sports analogy as well. I'm not a sports watcher. I like to play sports, but adding that perspective, looking at a quarterback comparison, it's not going to interfere with your core position, which I think is really a key benefit of pair trading. You can be long Coca-Cola and then also trade the difference between, United Airlines and American Airlines or something. It's not like those positions are going to move hand in hand with each other. So it's kind of a unique way to stay engaged and play all the interworkings, all the interconnectedness of those equities as well.
Absolutely, because within these, it's especially interesting between these indices. Like the individual stocks is interesting, but that usually requires more research that I frankly don't want to do.
And more capital.
And more capital, yes. I don't want to be looking into United Airlines and American Airlines as bottom lines, and then waiting for an outperformance that could take months or even years. I'm much more millennial, much more short-term thinker. I just want instant gratification. And what I trade off of here is just these two things that are similar. They're diverging a lot to what is a statistical outlier here in 2020. And today we're seeing some of that reversal. And that's why I trade these pairs in the indices, a big chunk of stocks against another big chunk of stocks that has a little bit of, overlap here, but it's a grouping of stocks against another grouping. And, that is creating for both short-term and long-term divergences. We talked about here in 2020, these first 9 full months as we enter October, equating to 30% of difference between STIX and SM75. Yesterday, you saw almost a full percentage point of difference STIX over SM75. Today, you've got SM75 outperforming STIX by 3%. A lot of moving pieces, short-term and long-term, that can set up for unique investments in the long term, but also just like yesterday, I mean, look at this, okay? This is the percentage movement in SM75 yesterday, this yellow line, never getting outside of a half percentage move. And so you would check your stock market and you would say to yourself, man, there's nothing doing in SM75. There's no opportunity. But what you see here is, okay, these two markets are right on top of each other. And then boom, 1 p.m., 12 o'clock, 1 p.m. hits, and they diverge by 0.5%, more than how either of them are really performing in their own outright basis. That's an opportunity within stocks now that you didn't see just from the broad viewpoint.
Mm-hmm. Yeah, I can remember when I'm looking to put on a position, a few weeks back. I mean, if you're not seeing something you like in any of the outrights, spreading it against something else is kind of a great way to change your perspective and find a new opportunity you wouldn't have otherwise noticed. And kind of the beauty of the small exchange products here in this perspective are everything is pretty much around the same price, around the same notional. Plus the contract specs are standard in such a way that there's no funky conversions anymore. My biggest pain point, I would say, pairs trading conventional products is there's this weird tick value. And I would always have to double and triple check my math. You have to normalize one against the other to equate the dollar value of a tick difference. Here, it's a dollar a tick on SM75 and a dollar a tick in STIX. So you look at the difference between the two, it's rather easy to compute your profit and loss.
Yeah, absolutely. Like here, you're looking at the price of the pairs, and it's in the same as the outright themselves. This y-axis here from -$4 to +$1 is worth $5 in whole, which equates to $500 notionally. Very easy. In the same way that this individual SM75 chart ranging from $30 to $55 equates to $25, which equates to 2,500 notionally. So yeah, it's funny, Michael, because I like both the points you made, and let's bring it back to sports because I am very one-dimensional here. But it's like you look at the specific game or the landscape for the NFL or NBA or whatever sport you like to watch that season, and nothing interests you right off the bat. But you're like, oh, okay, getting back to that quarterback analogy, I think quarterback A is going to pass for more yards than quarterback B. I see edge in that, not necessarily the team that's playing this week. And, this is exactly what we're looking at here, is going a step deeper with pairs trading to find something intriguing that you didn't see on the face of that market. And then also something that we take for granted in that sports world and everywhere else, where it's like, of course, we're going to compare yards to yards, but in a lot of other exchanges, at a lot of other asset classes, when you go to compare that, it's like you're comparing yards to home runs hit. And it's like, how do I even equate this thing across asset classes? And thankfully, all small exchange products are comparing yards to yards, apples to apples, just dollars to dollars when you are pairs trading.